Perfect. Okay. Hi. Well, I am Allison O'Hagan with Abode, and last week I got to interview Marlyn, and Marlyn's with American Pacific Mortgage, and we have another special guest here today. And Terril, if you wouldn't mind introducing yourself and your company, that'd be great.
Absolutely. I'm Terril Davis. I'm the owner at Platoon 720 Business and Credit Solutions, where we help families and individuals improve their credit scores. So that way we can they can improve their credit scores so they can be in a position where they can be approved for a home, refinance cars, or whatever it is to alleviate the financial stress on their lives. I've been in business now for a little over 2 years. I'm located downtown Tacoma. I am an Army veteran. We're a military family, so I do reside on Fort Lewis. So it feels good to not be from here, but to be able to bring solutions in this area, one community at a time.
Cool. I love it.
So a little bit, Terril, so tell us how you got into credit repair and helping clients out with their credit.
Oh man, I'm gonna make a long story short. For about 15 of the last 20 years, I did serve on active duty military, as I said. And throughout those years, I actually experienced a bankruptcy and a low credit score like 3 times because I thought all I needed to know was financial literacy. However, I needed credit literacy. I did not know how credit worked. And I thought because I can get approved, being military, we get approved for things just because we are military. But I did not know just because I can afford it didn't mean I can afford it. Meaning I would just sign up for things because my salary allowed me to pay for them. However, I began to have more month than money so many times. And so I knew after I ended my career that I would pursue another career in business, helping families with credit repair because I see that credit literacy is a shortage. And so when I first started my business, I helped over 50 families for free, so that I can get in there and see what is the main problem that's hurting our families. And lo and behold, there were so many families that was getting denied for home loans over basic things as not seeing their credit report for 1 to 2 years. They know they got denied, but they didn't know what they was getting denied for. They did not know anything about credit utilization, how important payment history was, or how age matters and how they needed a diversified credit report. So I knew that I had to make this a business and at affordable prices continue to help families get into the home of their dreams or refinance to lower interest rates. I serve the military community. That is my target market, military and veterans, because we have some of the highest interest rates on the things that we're paying for, whether it's a car, whether it's a home, even those credit cards that they have. I've seen some with vehicles with upwards of 16%. And it's not the fact that we don't have access to financial literacy or the resources. It's just that we don't know what we need until we need it. And so I have raised awareness for them to see and understand that you can get a lower interest rate to save $300 to $400 a month. You can get that home at a 3.9 or 4% and not have to get it at a higher rate. And so I have been having fun helping families throughout the Tacoma, Seattle, Olympia area.
Awesome.
It's so great. I know before I started recording this, I was talking to you a little bit, but I just feel like your services and expertise and education are going to be so necessary in the upcoming months. And I'm really excited that, you're available and willing to help families and individuals. And, I'm sorry, I'm like lacking the words, but you're basically going to be able to help them and educate them and guide them through this process in order to, update and improve their credit score.
Absolutely. And before this pandemic hit, we were already, getting a constant flow of customers. But now, as you see my board at the back, we're getting calls every day and people are really, really jumping on the opportunity to have a professional look over their report because now they're hearing about the changes in the bill that came out in the CARES Act and so many things that are taking place and they're scared. They heard about, the higher interest, the higher scores now that are required for home loans, and there you got questions, right? And so When I moved my office from downtown to home, I knew that I had to continue being essential, even though I'm not essential. I am essential, right?
Yeah.
So I made sure I let my clients and others know that we are available for them. And this is a time to start preparing yourself for after the pandemic is over, after this is over, they want to be positioned to get approved. They want to be positioned to take advantage of the interest rates, and I'm showing them how to do it.
That's so great.
So, what would be your recommendation? I have a lot of clients, and I think Allison and I can both agree on this, clients that come to us that have never established credit. And, you know, I sit down and I don't want to quite pull credit yet just because I know nothing's going to pop up. So what would be your recommendation for those clients? They may be younger or just have fear of credit and have never established anything. So what would be your recommendation for them to start building credit, and about how long does it typically take?
Oh, that's a great question. We have that question all the time. And one of the first thing I do when I have that question asked me, I say it depends. That's like my favorite answer now. It depends. Because it's so customized. I thought initially that if somebody didn't have credit established, that I can just tell them to do 1, 2, and 3, and they're good to go, right? Say, hey, go do this, and you're fine. But it's not general. It's not generic. It is customized to that client's profile. So if I get a 26-year-old who just graduated from college and he or she says they don't have credit, first I want to see the report. Regardless of the situation, I'm not going to take their word for face value and just believe that. So we look at the report, we look at the file, and we see what's in there. One of the first things, if it's blank and they don't have a score, then I first recommend a secured credit card. A secured credit card. Secured credit card normally $300 to $500. They have to make the deposit, and then that allows the company to establish a relationship, because credit is a relationship. That just means they had never been in a relationship with credit. So that's their first step, a secured card. And now I get them to understanding how this is going to work. Let's keep it at 30% utilization. That's our norm. I always tell them Netflix it. Just Netflix it if you don't know. Do Netflix, pay it off. Do Netflix, pay it off. And, you know, according to FICO, it takes 3 to 6 months of regular activity to generate a credit file. Next, I will tell them if they had tried a secured card before or something and it didn't report, depending on what it is that they're trying to do. For example, if they're trying to get a house, a secured card may not be enough because that's a $500 responsibility, and you want to get approved for a $500,000 responsibility, right? And so now I'm telling them, okay, let's consider becoming an authorized user of a family member's card who's using Discover, a Chase, and have a large balance available, a large credit limit. You know, now with that, they can adopt that good credit history to help them generate a score faster. And then we'll get them into other revolving accounts that they can get approved for regardless of their credit score. So I believe that it takes coaching for everybody that's starting credit, because even when they get the card or get access to that account, they need to know the importance of payment history and managing credit, because managing credit is so important. I have seen so many people, they got their recommendations from Google and from YouTube and the friend next door. So they got approved for these cards, but nobody told them that utilization can equate up to 165 points of their credit score. So they maxed out the card, they making minimum payments, and they wonder why their score is not moving.
Yeah, it's good information to know, right?
Yeah, so there's several other things that we do. Just to name a few, just real quick. Credit builder loans. A lot of banks now are doing credit builder loans. That's very similar to a secured card, but the difference is the credit builder loan is going to be categorized as an installment, because they're going to give the bank $500, and the bank is going to use that as like a forced savings, and now the bank will give them $500 back, and they are paying on that until it's paid off. They have the $500 that was given to them as a collateral, just in case they don't pay it back. The bank didn't lose their money, but that person did lose out on the relationship because they took advantage of it. They used too much and they did not give enough back. One of the things I really like about Experian, they're allowing them to do Experian Boost, where they can report their utility bills, their phone bill, and it's going to go on there as self-reported. The thing that I don't like about that is companies still see it's self-reported, right? That's Miss Martinez self-reporting herself. So we can't trust your word because we know you trust yourself, but we don't know if we can trust you, right? And so it helps with, there's over 50 different FICO scores out there. So that goes towards another different FICO, and it's not even weighed in the scores that that lenders are even looking at now, right? Am I right, Miss Martinez?
Yeah, because we've seen those self-reported on credit reports, and as of yet, it's still something so new to us that, you know, we've kind of just taken it out, because obviously we're not going to want to include a utility bill as a liability for them, you know, on their credit, because those are, you know, those are a few $100s, and now their debt to income just went up because of a utility bill. So it's
Absolutely.
still something new for us that we're trying to figure out how to deal with it. But for now, we've just been excluding it as a liability. But yeah, it does show on there self-reported.
Absolutely.
Yeah.
Absolutely.
Awesome. And then I know that you had some questions for us, Terril.
Yes, my clients have questions for you guys. So as we see in the CARES Act, they're hearing the rumors of the scores for FHA loans are going up, and my veterans want to know, is that affecting VA loans? And if so, what does that look like? And how can I better position them now? Because just 2 months ago, we had a goal, and now it seems like those goals are changing. So what are those scores looking like?
Yes, so all government loans, they changed their guidelines, like a few weeks ago, maybe I wouldn't say quite a month yet, but any FHA or VA loans or USDA loans, now the minimum credit score for that is a 640. Before we were able to be super lenient, FHA was as low as a 580, and VA was the same thing, and now they're up to a 640. So yes, that is something that is in effect now, that moving forward, all government loans, we need a minimum of a 640 credit score.
Wow. Wow. And that's including VA too, right? Correct?
Mm-hmm. Yes, VA, wow. FHA, and USDA loans.
Wow. And see, that's a game changer for us, because right now, you know, I don't only just do credit repair. My clients are getting direct coaching and mentorship, and I am actually watching them govern their credit scores while we're doing this. And now having direct communication with my lenders and my realtors, I'm able to position them to where it can make the process smoother, so they know, okay, these are things. One of the things we have them do is pull the actual FICO, because they don't know that there's a difference between a Vantage and a FICO score. So a Vantage score, you can generate a score within 30 to 60 days. It don't take 6 months. FICO score still takes that. So some, even now, I don't know if you have seen them before, where they will pull the Vantage 3.0, which Experian, Equifax, TransUnion, Innovis is a fourth bureau now that's kind of like, you know, growing up with the rest of them. The monitoring services, they see one score, and one of the scores don't even populate, and they're concerned because they don't know that it has not been 3 months yet. So you can sometimes be, you know, not have an Equifax score. The difference between Advantage and a FICO as well would be, you know, they right now I have clients that are at the 680, the 690s, but if we pull their my FICO, it may be 630, 640, because there's different factors that they're looking at, and they think because they have $200-300 secured cards that it's going to weigh the same on a FICO score when it's time to get a home loan.
And I see that all the time when clients, you know, they come to me and it's like, oh, Credit Karma, it's telling me that my credit score is, you know, 720 or whatever the case may be. But then when we actually pull the FICO, it tends to be a little bit lower.
Yes.
Probably, I would say anywhere between 10 to 20 points, maybe sometimes more. And, you know, I think it's always explaining that, okay, yes, Credit Karma does give you a score, but it's more of an estimation versus what we're pulling is an actual hard inquiry on your credit. So it is interesting to see how, you know, those two really are quite different.
Yes, and we want them to focus more on the file, and that's a file difference right there. We focus here at Platoon 720 Business and Credit Solutions. We are focusing on the file, and we have to train our clients not to look at the score. So therefore, if we're focusing on the file, if the Vantage score, I just had a client this weekend, the Vantage scores and the the FICO score was right about 5 points off. Because we focused on the file, I knew that there were things that the FICO was going to weigh about the same as Vantage. And that's what we went after. And with that, that's going to allow me to send them back to their realtor, back to their lender, and go through the process smoother.
Awesome. And then I know you
have another question.
Yeah.
I'm trying to think what it was. I think do families need a large amount of money in the bank or in their savings in order to get approved for a home loan?
No, that is one of the biggest misconceptions in the mortgage industry, that you need to have 20% down for down payment. When in reality, if you're a first-time home buyer, you've got options anywhere from 3 to 3.5% at the minimum for the loan. And then you can also get in with a, conventional, you could do 3%, 5% if you're not a first-time home buyer. So no, you do not need to have a lot of money in the bank for down payment. There's also down payment assistance programs in the state of Washington that they will let you borrow anywhere from 3 to 5% in down payment. And it's a silent second loan that collects no interest throughout the loan, throughout the term, unless they sell or refinance or finish paying off their loan, then they have to pay that money back.
That's amazing. That's great news, because I didn't know that. I have a client right now. We pulled my FICO. He called me, and his score's at 670, 680, and I think like a 692. And he said he wanted to get a home in about a year and a half because he got to save up $25,000.
Oh, yeah.
Yeah.
So yeah, there's some people who will have some money saved, and it's, on top of their down payment, they have closing costs. So sometimes we'll restructure their file to see, do they have more money available to them or that they can get in the form of a gift? If not, we'll look at doing the down payment assistance and then using those funds that they have to pay for their closing costs. So we don't have to, negotiate too much with the sellers in this market.
Can clients, so for example, if I needed him to see one of you guys, and say, hey, let's go ahead and go through a pre-approval or pre-qualification so that he can have a clear vision that maybe he don't need to wait another 2 years. He's good enough with where he's at to go for the next 3 months. Is that something that you guys provide?
Absolutely.
Good.
Yeah. And I always suggest that you do have that, at least a pre-qualification, but more often than not, you want to be pre-approved and through as much of underwriting at least as possible, because we are seeing things to slow down a little bit, but overall it's still very much a seller's market. And so as a buyer, you just don't have the leverage unless you've gone through that pre-approval process.
Okay.
And you don't really want to start home shopping until you know what you can afford. And so your first step really is to go to Marlyn and get that.
What's the difference between and I know it, but I want my people to know it. Difference between pre-qualification and pre-approval. Is there a hard pull involved in one step or the other, or is beginning at qualification?
So the pre-qualification just basically means, you called me up, I took an application, you told me, hey, I make this amount a year or a month, this is my salary. You tell me, we take all from where you live in the past 2 years to your work history. I go ahead and pull a credit report. And then what makes it a pre-approval means I have verified, you've provided me all your documents, pay stubs, W-2s, tax returns, bank statements. We have verified income, social security number, W-2s or tax returns if we need to. We have verified employment, which is a huge one. And then we submit the file to underwriting, and underwriting does that analysis to really verify that this client truly does meet the guidelines for the loan. And they come back and give us an underwriting approval. So at that point, they are fully pre-approved and underwritten, which is very important, I feel like, in this market, because that's what sellers want to hear, is that there is not going to be any surprises on the loan. And so that is really the big difference. When I start my initial conversation, a lot of clients always say, okay, so I'm pre-approved for this amount. I'm like, no, I don't want to confuse you. Right now, you're pre-qualified for this amount. It's an estimation based on what you have told me, but I have not verified any of it. So as of right now, you are pre-qualified. But yes, definitely, we try to move them as quickly as possible from that pre-qualified conversation quickly to the pre-approval so they can go out home shopping with Allison.
Nice. I love it. I love it. And what areas do you guys serve?
So I'm licensed in the state of Washington, but I know American Pacific Mortgage is in almost, I think, all 50 states now, so I can easily refer clients over to a different state. I'm in the works of trying to get my license for Oregon and California and Arizona, so hopefully that'll happen within the next few months.
Good.
And
And you, Allison, what area do you work?
Yep, I also can serve anywhere in Washington, but I like to serve Tacoma and the surrounding areas and refer clients out to other agents in, the specific area they're looking. It's so great to have boots on the ground in the area you're looking, and just to have that knowledge and, about that market. Because if you're looking at, Seattle to Tacoma, the markets are way different. And so you really want an expert that knows your area and your region. And for me, it's better for a client to just be referred on to another agent outside of my area.
I love it. So now we have our clients that, for example, now during this COVID, this pandemic, a lot of lenders are giving them forbearances, and some are putting it on the back end. And some are, after this is over, you are 3 months behind and it's going to catch up with you, or we'll split them up over the next 2 years, 3 years. I've heard different things. How is that going to affect them during this time, being that there's nothing really being reported for this time?
So I think the big thing is, what I'm advising my clients, all my past clients that I've done loans for, or even clients that were ready to move on to a different home that already have a home loan, advising them that if it's something that they truly need, which is to get into forbearance, that they read the fine print and they know how they have to pay that money back, because, there has been so much conversation, and my sales manager have coached us that we need to reach out to our clients before they hear anywhere else that, hey, it's a free 6-month no mortgage payment ride, and, jump on that bandwagon and not know what they're signing. So to me, it's been really beneficial just to reach back out to my clients and let them know, like, this is not a free ride. This money does have to be paid back. And just to be careful with what they're getting into, because, there's going to be some clients who, aren't advised from their lender, and they do go into this, and, if they have to, if they're saving 6 months of mortgage, and then after that term is over, the lender comes back and they're going to need to, make that payment right then and there. And if not, they're going to, take that out to maybe 12 months where they divide, let's say their mortgage payment, let's just say is, $2,000 a month. They don't have a payment in 6 months. That's $12,000 that you haven't paid in your mortgage. Right. And they're going to go ahead and divide that out over 12 months. Your mortgage payment is going to go up $1,000 for the next 12 months, and you will not be able to refinance once you are in forbearance. So that's going to get a lot of people into trouble. So I advise, read the fine print, know how you're going to pay that money back. And if you can make your mortgage payments, continue to make them. That would be my biggest recommendation, is don't think that this is a free, mortgage payment ride, because truly it's not. Like, we're going to, lenders are, we're all going to want our money back, and, we're going to try to figure out how to get that from you guys. So it's very important just to read that fine print.
Cool. Thank you.
Yeah. Terril, did you have any other questions for us? Or
student loans. Let's talk about student loans and medical bills. That's one of the biggest things. At least 8 out of the 10 clients that I get have student loans or medical bills. How does that affect them in going through the pre-approval or the approval process?
Yeah, so it depends which loan program we're looking at. If we're looking at a VA loan, if the client can provide evidence that their student loan is deferred for at least 12 months beyond the date of closing, then we do not need to include that in their liabilities. But if it is something that they are currently making payments on, we will be using, whether it's showing a payment already, or we will use, we'll take 5%. If it's a student loan that's not showing any payments, we'll take 5% of that student loan and divide it by 12 months. And that will be their monthly payment. So it just kind of depends, if it's showing something or if it's deferred, we can go either way. As for medical collections, those are typically not included in our debt to income ratio because we know life happens, and we are all in medical debt. It happens, and it's something that we cannot, what's the word I'm looking for, count on and know that it's going to happen, because it's really something we don't know. Mm-hmm. So that we do not include that in our debt to income ratios. Cool. Now, as for FHA, we do need to include a payment in there, even if it's deferred. So it's going to be the greater of the monthly student loan payment that is on their credit report. It's going to be, if that's greater or 1% of the amount that is due. So 1%, whichever one is greater, we're going to calculate that into their debt to income. And then for conventional, we will be just using whatever's showing on their report. And if nothing is showing, then we just need to, verify that they are truly not making. If they're on an income-driven type of this payment plan, then we just need proof of that. So we're going to take whatever's on there.
Okay. So the same rules apply for forbearance.
Correct.
Okay. Good. Thank you.
Yeah, and they change from program to program, but they're pretty much, I think the student loans is the ones that varies between the 3 different loan programs.
Okay, cool. And I know there was so to talk about the process of credit repair and some of the challenges that we face. The process of credit repair is basically we review their report. We have to review their report, preferably if they're going to buy a house, if they're seeking to buy a house within the next 6 months. We're going to pull a FICO score, not a Vantage score, to get the realistic data from the report. We're going to look for any negatives. We're going to identify all negatives, inaccurate, untimely, unverifiable information, because that stuff can be removed if not updated properly. Once we've done that, I identify the things after taking an interview with the client. If they say, "Hey, this is not mine. I don't remember that," we will have the furnishers validate that. We will have the bureaus verify. Only the credit reporting agencies can verify. The actual furnishers have to validate. That means we're looking to see, why do you have this account? Are you authorized to collect on this debt? And if not, cease collection, give it back to the original owner. Those are the type of approaches we take. Now, I want to say worst. I don't want to use the word worst case scenario, but when they have properly validated, and let's just say it's a $12,000 account that's within the statute of limitations, within the last 2 months or whatever, we like to do negotiation as well. Negotiation for settlement. We like to have those conversations that a lot of companies are now negotiating at a fraction of the cost, like 40% of the total balance. And if we can get that handled in a timely manner, because it means whether or not they're going to get a home, we take that approach. For these collection agencies, most of them now are doing pay per delete, meaning once they pay whatever it is that they owe, they will delete that collection account from their report. That's after they validate it. So that's after I validated to make sure they have the right to collect on the debt. Everything is true and verifiable, and they have shown the documents, and this client cannot avoid this debt, then we're going to take another alternative method to take care of it. I had one client had a $12,000 debt with Navy Federal, for example, and it's about 3 years old. Navy Fed settled that account at $3,600.
Wow.
And so they took that balance to zero, even though it's still on their account. It reported as an improved account. So now it's not counted against their debt to income ratio, because now that's zero. Yeah. So that client got 32 points back. It's a myth to say all of these things need to be deleted. There are other ways for us to handle accounts whereby they can now have a better score and get into that home at a good interest rate.
So when you negotiate an amount owed, like so let's say they're offering you the 40% discount to pay off that account that you owe, is that something that you have to have cash for, or can you still set up payment plans for that?
That depends on the company. Okay. Even then, once we instruct our clients, the ones that like to do it themselves, I coach them. Once they receive that, it says we'll take 40% of this. we have them agree with them that they would have that account removed from their report in writing.
Yeah.
There are those who would say, yes, we will, but after they paid, it don't get updated, it don't get removed, and now we have another problem because this client is out of $3,200 or whatever. So we try to make sure everything is done in writing, because a lot of these collection agencies, we're realizing that they just have an LLC and they bought it from downtown and they went and got this from across the street and they're just trying to collect. And what I'm doing now, I have a group of consumer rights attorneys. They are reviewing all collection agencies that my clients get to make sure that it's legit. And if anything on that is violated, they go after and countersue and possibly get our clients' money now.
Wow. So how long does it typically take for somebody to repair their credit?
We have seen it in as little as 45 days, but it can take up to a year because it depends. And there are hurdles that prevents this. One of those are lack of communication between us and our clients, meaning the bureaus and the agencies and the collection companies are going to begin to respond by sending them mail. And if they don't get that to us or consult with us so that we can look at it and tell them what's the best plan of action, then time is working against us. That means now they could probably sell it off to someone else. We're not able to respond in a timely manner to handle things, to where now it just makes it worse. Or we have a client that still thinks it's okay to shop and max out credit cards or apply for new ones while we're working on their file. We also have those other ones that they are, I won't say disobedient, they're hard-headed. They see a collection that comes in the mail and it says, we'll take $500 for this, $700. They go ahead and pay it immediately. But now it's still on their report and the company didn't update it. Then perhaps the company didn't have a right to collect on the debt anyway.
Oh, man.
So it can make it longer, it can draw it out. But my clients that listen to me, take our recommendations. Oftentimes we are seeing them out of our program 90 to 120 days.
That's amazing.
If they're in there longer, it's because they're sitting on their mail and they have not uploaded their documents so that I can give them our next plan of action.
That's amazing that, in 90 days you could turn around somebody's credit.
Absolutely. I've gotten up to 12 to 15 deletions in 30 days.
Wow.
Because there are you have debt buyers. They'll just go and buy spreadsheets and not the actual contract. And so when they get it, it's just like me going to AT&T and they give me a spreadsheet of 50 people for $100 because they couldn't get in touch with these people. And now because I'm generating documents to send, people are paying and it's not helping their report because these companies have not been validated as legit. Wow. So that's what professionals are for.
Yeah, because I think I would think just, thinking from experience, like my parents, they've gotten sometimes like scam in the mail where it's like, hey, you owe this in collection. And their first instinct is, oh my gosh, I have to pay it off. Like, even if they don't know what it is. So it's, I definitely see what you mean there, because sometimes it's like, no, don't pay it. What are you doing? Like, it's not yours. And let's really look into it. And they do, tend to be scams or, my parents are pretty good at paying all their stuff. So it's like, if it's not yours, why would, why would you pay it? But yeah.
Yep. All clients are required to have a monitoring service outside of Credit Karma, and Ms. Martinez know how I feel about Credit Karma. So outside of Credit Karma, because Credit Karma gives you limited information on purpose so that they can sell them so much stuff, insurance, deals, all the junk mail that we get comes from Credit Sesame, Credit Wise, and Credit Karma, the free sites. In exchange for that, they are making money by seeing our clients get denied, because the Vantage score says 631, and they say you can get approved for Discover, but Discover needs a 680 FICO, for example, and they're signing up for these things. But we require them to have a 3-bureau credit monitoring so that they can watch their score, and we teach them how to read a score. You'll be surprised of how many adults in America today do not know how to read their credit report. So we teach them how to do it, and we have them turn on their alerts so that they can see if something happened. I have 2 clients over the past 72 hours that they had rolling 30-day lates on their mortgages. Rolling 30-day lates. One was for 14 months of 30-day lates.
Wow.
And it comes out automatically. So she's not tracking that. And she's not watching her score, but it's 30-day late rolling. Another one had 4 months of 30-day late rolling. And what happened was they changed their date verbally by phone. And so they do, instead of paying on the 5th, it was an agreement that says they can pay on the 26th, for example. Now it's actually late. They're 1 month behind every month.
Ooh,
it's been late.
Nice.
But because they're only $1,400 late, $2,300 late by 30 days, no one is going to call them and say, you're about to go into foreclosure or you're at risk, because it's happening. But it says late 30 days, and it went on for 14 months. Wow. And their score is at a very, very low 5.
Wow.
Because of that. And so I'm helping them fix that.
Yeah. So how would somebody know that they need professional help to improve their credit?
After they've tried and got frustrated and got no results. Or if you're too preoccupied, like, for example, think about the money that we as business owners, self-employed entrepreneurs make per hour. You know, if I'm talking to 3 or 4 clients, you know, and I'm making $150 an hour, then we're looking at what, about $600. But if I'm spending 4 hours trying to fix my own credit, I'm missing $600. So I need to outsource that headache. I believe that we should outsource the things that gives us a headache and the things that we don't know. You know, I usually didn't know how to cut my hair, but now it's easy, right? I would go to the barber, you know, but now I can do it myself because it only takes me 15 minutes. But I have a Honda Genesis. I'm not about to Google how to change that oil. I got better things to be doing. And so we always tell our clients, you know, try to do it yourself. By law, we have to tell them that you can do this on your own. However, if they don't have time and they don't want to learn, then that's when you need a professional.
That's so great. And I think, like, at least for me, if somebody's holding my hand along the way, I'm just that much more motivated. I'm sure that you continually check on your clients and say, hey, did you get this done this week? Did you, just having somebody there that's your cheerleader behind you, I feel like you're automatically going to, achieve what you're going for.
Allison, that's what makes us makes us different. That's why I got my board. All those names checked off. That's the phone calls I had to make today. Close out some people and check on them. And what it is, we're not using AI. We're not using artificial intelligence to take care of our clients, as most credit repair companies are. Okay, we are there calling them. I call them, and I don't have a team, from others that call them. I make sure I call them myself and find out how they're doing, do you have some mail? Have you signed up for these recommended resources? Because based on their file, I have a list of recommended resources that approve any score, because we want them to have a diversified credit file. We want them to have at least 2 or 3 revolving credits. We need them to have at least 2 installments. And then we even go for a retail or a charge card if their credit score permits. Because once they come to you, we want you guys to understand that this person can be trusted with diverse relationships. Yeah, he got revolving, he got installment, and he's doing good. He's balancing well. And I think that right there triggers the algorithm of the credit score and gets them in the house that they can get. You may have seen some that have a 701 and cannot get approved, but then somebody come behind them with a 635 and they're in. Because one is more diversified and responsible than the other, but then you have the other one that has 5 authorized users and never showed that he or she has responsibility over a long period of time.
Yeah, and we've seen that in the past where, we'll have a client that has a score in the 700s but doesn't have that history, versus somebody who's probably, let's say, 650s that has a history, even though they have a lower score, they get approved all day, every day, versus somebody with the higher score that doesn't have the, the credit history to back them up on that. So it's
absolutely. So I have one more question for you guys before I let you go. Man, this has been amazing. Thank y'all for your time and the opportunity. So how does authorized users weigh against them of getting approved? Because in the credit repair industry, it's a high risk industry. literally in the state of Georgia, it's a misdemeanor to own a credit repair company, like for real. And I have some that ask me, do I sell trade lines? And I tell them, no, I don't, because I want my clients to get approved for their first home. And what they're asking me is, can I add 4 to 5 trade lines to their report that's owned by strangers, and it's going to stay on there for 60 to 90 days, and they can get approved for a home.
That would be something I'd have to look into, because I have seen in the past where we have authorized users, but they're usually family members, right? So we can just, and it shows up on their credit report that it's an authorized user, but then now if we're talking like every trade line is an authorized user, then that may, you know, be a little bit different. So I'll have to get back to you on that one, because that's a really good question.
I would greatly appreciate it, because they are convinced that they can take a shortcut as such. But I understand, my understanding shows that there has to be some type of responsibility from the person that's about to make this 30-year commitment, this 15-year commitment with $500,000.
So they're finding ways around it, right? They're trying to.
Yeah. So I let them know that it's still the file is more important than the score. And if the file has 5 people that is carrying you and you have not walked yourself, I'm not sure if you're going to get in the house.
Yeah, that would be something. Like I said, I'll look into it for you and definitely send you an email on it, because like I said, I've seen it with one.
Yeah.
But now, you know, if you have a ton of them, then that, I don't know how. I think it might just be up to something like running an automated underwriting system and see what it says, and if it likes it and if it doesn't. Because it typically does pick up on those. If it is a authorized user, then it'll just call it out and take it out of their debt to income ratio. But yeah, that would be an interesting one to get an answer for you on.
Good. Thank you. Yes, I never did more than 2. And when they find 2 family members, go with those 2 or whatever. But trying to find a whole team to carry you to such a table as this, I'm not sure about that.
Wow.
But thank you guys, man. It's been
great.
Great.
So one last question really quick that Allison and I wanted to ask you is, the big one is, how do people get in contact with you if they need help, even if it's just a small question on like, I've been stuck at this credit score for this long and I want to just jump it up. And then what about your, consultations and, how do they pay you for your services?
Okay, we're very affordable. We have free consultations. So they can find us on Facebook at Platoon 720 Business and Credit Solutions. They normally message us through there. There's a book now button on there as well. They get a free consultation, or they can go to our website at platoon720.com. All our information is there for them to ask questions. I have a little chat. I put a little chat guy on there now, so they can talk to him and get that's directly to me, or they can call my office phone or my cell phone to set that up. By law, by CROA, Credit Repair Organization Act, we're not allowed to take money up front. So my clients, once they are enrolled in our program and they qualify to be in our program, they're billed 7 to 10 days after the program has started. Once their first round of letters have went out, we put the report, we talked about a game plan with them, and then they are invoiced by our company via email 7 to 10 business days after the process has started. So we're very affordable. Like I said, we're $24.99 right now to sign up throughout this COVID pandemic time. And then we go back to $69 and $89. Nothing is over $100 dealing with us. And we make sure they're well educated and they have vision as far as what it's going to take for them to get from here to there.
Thank you. But, one of the things I really like about sending clients to you, Terril, is, we've kind of talked about, I've had clients in the past that see all the ads for, Lexington Law being one of them, and they start them on a monthly service, $99, and then they tell them pay off your smallest debt and work your way up, which is almost impossible. So, I love the fact that I can be able to refer somebody to somebody who's local and can schedule a one-on-one appointment with them. And also one of the things I really appreciate is that, even if it's on the weekends or anytime, if I can, if I shoot you a text and you respond back to me immediately. So that's awesome. I love just being able to, get in touch with you and make sure, if I have a client, you call them right away, which is really, really nice.
Absolutely. Thank you guys so much, man. It's been good.
Thank you. And Marlyn, how can everyone reach you as well?
So same thing. I will put my phone number and email in the bio. I'm also on Facebook and Instagram. If you search me at Home Loans with Marlyn, I'll pop up on there. But yeah, we'll have, I think, all of our contact information in the bio once we post this up on Facebook.
Awesome.
Cool.
Thank you for your time and your expertise, and I'm really excited that clients, have both you at their fingertips and local.
Thank you, Allison.
Absolutely.
I'm excited.
Thank you, Allison.